Welcome to Looking at the Markets with David Modell. Today's topic is, what are naked options? And should I sell naked options? All right, let's talk about that. First, the definition. Naked equals uncovered. If you sell options, you're collecting a premium or a payment in the hopes that the options that you sold don't go in the money. Sell a call, for example. You're hoping that the underlying stock price, and it's not always a stock, it could be an ETF or a commodity or whatever. But yeah, if you sell a call, you're hoping that the underlying stock price doesn't go above the strike price. If it does, then you might be required to sell 100 shares of that stock at the strike price. That's not so bad if you already owned the stock shares. You would just have to sell them. Or if you had a call spread, meaning you had not only sold the call, but had also bought a call as well, so that your maximum loss would be limited. Okay, so yeah, there could be some loss, but at least it's a limited loss, a defined maximum loss. But what if you didn't own 100 shares of the stock and didn't make your call sale into a spread? Then your call sale would be uncovered or naked. Well, similarly, if you sell a put, you're hoping that the underlying stock price doesn't go below the strike price. If it does, then you might be required to buy 100 shares of that stock at the strike price. And again, that's not too bad if you had already shorted the stock shares. Then you would just have to buy them, perhaps even covering your short position at a decent profit. Or if you had made it a put spread, meaning you had not only sold the put, but also had bought a put as well, so that your maximum loss would be limited. Again, could be some loss, but at least it would be defined and your maximum loss would be known beforehand. But if you hadn't previously shorted 100 shares of the stock and you hadn't made your put sale into a spread, then your put sale would be uncovered or naked. The maximum loss is undefined. Selling naked options involves what we call undefined risk, meaning that your maximum loss can be unlimited, especially with calls. If you sell a naked call and the underlying stock price just keeps going up and up, you're losing more and more money, and there's no limit to how far the stock's price can go up. Think about it. There's no upper limit to how far a stock's price can go. It could just theoretically go infinitely higher. And you'd be losing more and more money as it goes higher and higher if you had sold a naked call. Now, what about puts? Well, if you sell a naked put and the underlying stock price keeps going down and down, you'll be losing more and more money as well. Now, there is a limit to how far the stock's price can go down, since it can't go below zero. Think about it. A stock's price can go down and down very far, but it can't go negative. So it can't go infinitely down. Still, though the maximum loss isn't infinite, it's still considerable, especially if the stock's price goes to zero. And bad things can happen to good stocks. You might think that you're safe as long as you only sell options for blue chip stocks that don't move much. Okay, and we might think of General Electric or maybe Ford or perhaps a utilities stock. We might think that those are stocks that are not as volatile. However, even so-called safe stocks can make big moves, especially after an earnings report, an analyst upgrade or downgrade, or a news event. Besides, entire markets occasionally crash or correct. If this happens, then all blue chip stocks are likely to make a sizable move along with the overall market. So even if you have a supposedly safe stock, you know, these things can happen and they can make a big move, and you can still get into a bad situation if you sell uh, if you had sold a naked option for that stock. So what's the takeaway on all this? Well, typically, if you're going to sell options, which I don't recommend for people who don't know what they're doing, okay? But if you're going to sell options, I recommend buying some options as well as selling them and making it a spread. It's this kind of safety first policy that promotes longevity in the highly unpredictable options market. So yeah, if you feel like you need to sell options, which is, again, something you have to know what you're doing if you're going to do that, I would say make it a spread. Sell some calls, but also buy some calls. Or sell some puts, but also buy some puts. Make it a spread, have a defined maximum loss. And that way you'll be able to sleep at night a little bit better. And if you need more help with any of this stuff, whether it's options, stocks, buying, selling, whatever it might be, finance in general, or putting together a trading plan, because I hope you have a trading plan. If not, then the results will not be optimal, to say the least. You can contact me. My name is David Modell, last name Moadel, and my email address is davidmodell@gmail.com. If you like this video, please give it a thumbs up on YouTube. Feel free to leave a comment. I really appreciate the comments. And subscribe to my channel if you haven't done that already. That way you can receive the latest educational content. All right, so thanks a lot, and I really hope to hear from you soon.